Okay, so the first is just a verbal question. Can we explain this micro foundation we had in the background? Right? This is also then think of potential sort of exam question from the basic New Keynesian model would be to explain, give an example of a friction or a micro foundation behind this assumption of capital price. Verbally, we've talked about this on the slides too a little bit, so maybe a menu cost, or maybe the cost of determining the optimal price. Right? Imagine running this study or the like, or you have customer relations. The service price, as I told you, is also something that these prices are very constant for a long time. For me, I always use the example of getting my hair cut. So I go to the same place in Frankfurt all the time. Why? Because I just go there. There's not a whole lot to do here, right? It's just, So I just go there and do my haircut. There's no reason for you to change. There's nothing to think about. But the moment my hairdresser raises their price, oh, I should pay more? Well, wait a second. There's nothing special about my hair anyway. Maybe this is now a time to shop around and see if I can find someplace better or someplace cheaper. So, and the hairdresser knows this, right? The moment when they raise their price, this is going to disrupt existing customer relations. People that have been happy with just buying, continuing the service all the time, are now thinking about changing their service. You can do the same thing with maybe a cell phone or an internet plan. You pay the same amount every month, and you're fine with that. But when they raise the price, then you as a customer think about, wait a second, should I keep doing this? Should I pay the higher price, or should I shop around? So these are just three examples of the micro foundation or the intuition behind sticky prices. In fact, we looked at yesterday an optimal financial contract, an agency problem between the lender and the borrower. Right, so we have a lender who agrees upon ex ante the price that they're going to charge for loaning funds to the entrepreneur. Now, the reason why this is also agreed upon beforehand, right? You could think of a different way of setting this up, and this maybe help us understand why this is important, how the asymmetric information works. So imagine, so one way to set this up would be that the bank offers the borrower a contract that they have to pay back. Their repayment next period is based on their idiosyncratic performance, their idiosyncratic productivity. So the bank can structure a contract that your payment next period is going to be 0.5 percentage point less than whatever your idiosyncratic performance times the average rate is. This way, as a borrower, you're guaranteed to have a 0.5 percentage point profit, and the bank is always going to get repaid. Right? We could make a state contingent contract. So imagine, we lend funds to entrepreneurs as an institution, right? And we let them pay back according to how productive they turn out. So this would mean the very productive firms pay out a whole lot, and the unproductive firms don't pay back as much. But we don't have any bankruptcy. Right? You could think of interpreting this right, from Marxist Leninism, right? From to each according to their needs. All the entrepreneurs have the same funding requirements, and from each according to their abilities. Right? So the realization of their idiosyncratic productivities. Why is this not possible here? We don't know what people's productivities are as the bank. We would have to trust and believe these entrepreneurs to tell us the truth. Now, not you, not I, but there are some people out there, some entrepreneurs who would have a really high productivity, and when the bank came, Next period it says, okay, tell me what your productivity is so I can determine how much you're going to pay me back. And the entrepreneur says, oh, I had a very low omega. A very low omega, not productive, I don't want to pay any money back. Right? There's some people like this, right? This would be fantastic for the entrepreneur. They would pay back a very low amount because they lied to the bank and said that they had a low productivity drop. In fact, they had a high productivity drop. We maximize their profits. Indeed, if we put profit maximization into the firm's problem, of course we do, and we give them the option of what they report, they have an incentive to self-report, not accurately, but a lower productivity than they actually have. Everybody's going to cheat a little bit to increase their profit from half a percentage point to more. Consequence of this, well, that's going to be lower income for the bank, right? So they're not going to be able to finance this, these loans with only half a percentage point profit. They're going to have to lower this margin, right? Then firms have an incentive to. We have this conundrum that since banks cannot observe how productive what your productivity actually was, we cannot make the repayment state contingent. Okay, so if we cannot condition the repayment rate based on the realized productivity, the best we can do as the bank is make it conditional on, say, the expected productivity. Right? So we're going to use some ex-ante knowledge about this distribution, right? Which is how we set the rate. The monitoring costs, and we still have some monitoring costs then. Take it up here. They arise, we thought of it more as bankruptcy costs, so the costs that come about after the fact. So if a firm does go bankrupt, how do we recover the assets or value from the assets? Right, so it's this individual gross capital payoff. Right, maybe, obviously we can see how much capital perhaps the borrower purchases, right? This could be part of the contract at time T, but we don't see the realization of their omega. Now, what we would like to do, right? We want to make sure we return a profit as the lender. So we'd like the borrower to choose an amount, to borrow an amount, such that they're able to pay us back what we loaned to them. But only the agent, only our borrower, can observe the realization of omega and hence the total true returns. Right, and so another way perhaps also of thinking then about these monitoring costs is in order to ensure or to reduce the likelihood that people are going to lie to us, right? We would monitor them. And this is a cost which is going to, which we will pass on to our borrowers. Right? But we observe this then after the fact. Now, we kind of, there are different ways we could think of rewriting this problem. This is the interesting thing. This is then, micro. What if we wrote this so we had a payback, a payoff, a return payment of J that was dependent on the realized productivity. Right? But we as the lender, then we'd pay this mu for all J. This is going to change the problem. It'd be interesting to look at in a micro course, right? We're just going to take this as given. So what happens, we're going to set Z ahead of time. It's going to be the same for everybody. And the borrowers who are able to pay us back do, and those who don't, we have to, they go bankrupt, we have to foreclose on their properties and go through the process of figuring out what it's worth. So think of this as bankruptcy costs. So let's interpret our the optimality condition for our loan contract. Well, we actually have, this is just an arbitrage argument here, right? We have the expected return to the bank from lending out to firm J at this agreed upon loan rate Z, given the fact that there's going to be realizations of omega. So what we're also assuming here is that the bank doesn't know the actual realization of omega, but it knows this distribution. It knows this F, right? It knows the distribution function of omega. So I don't know what your individual productivity is, but I know that it's drawn from a standard distribution, standard normal, right? Or whatever the distribution may be. And on the right-hand side, we have an alternative, and that would be taking the same funds that we would loan to the firm, the entrepreneur, and instead investing them on the market in risk-free bonds at the risk-free rate RT plus 1. Right, so this gives us this arbitrage or indifference. If we look at these two different, break this apart. Right? This first part here gives us the gross payments of the loan weighted by the probability of non-default. So this gives us our expectation of being paid back the loan at the agreed upon price. And it's not every firm that's going to be able to do that, not every entrepreneur. So the expected payout is based on what the probability is that this entrepreneur has an omega above this threshold. Right? And if the firm is drawn from, has an omega that's drawn from below this threshold, well then this entrepreneur is going to go bankrupt. This will be the value of their assets. Right, so we have then the expected value of their assets conditional on them going bankrupt. And we don't get all of the assets back as the bank. We only get a fraction of this back because we have these bankruptcy costs. Right on the right hand side we have the alternative, going out to the market, buying bonds at the riskless rate. And so there's something I want you to think about here more than just the content, right? So it's also, trying to give you some that are kind of funny, so if you don't know what to do in an exam anytime in economics, take a derivative, right? And then try to interpret the conditions. That's the master's level. Let's get this marginal cost, marginal benefit, or an arbitrage argument. Yeah? And so that's what we want to try to do here. Right? You can rewrite this in different ways. Let's call this let's try to reformulate this arbitrage condition maybe differently. So let's just look at the total gross return on lending minus the unit cost of lending that we have as a bank have to cover, and compare this with investment on the bond market. We have no cost per unit, so we just have this risk of return RT plus 1 required. So we can split this into conditional on split this into the two cases. What's our expectation given conditional on the firm going bankrupt or the firm returns if we don't know we use the law of iterated expectations. We're going to calculate, first figure out what's the return if they don't go bankrupt, what's the return if they do go bankrupt, cost if they don't go bankrupt, cost if they do go bankrupt. And then when we calculate the expectation that's not conditional as realization, we're just going to multiply with the probability, right, that omega falls in one of these two categories. So here we have the returns. If firm doesn't go bankrupt, returns if it does. Costs if the firm doesn't go bankrupt. No costs if it does. firm doesn't go bankrupt, then it can pay us back. This is just going to be times probability. Right, if we go bankrupt, the returns that we're going to get are going to be what we're going to cover is going to be what the actual production is of the firm. So omega I t plus 1k qt ki t plus 1. The expectation of this. So this is the total. Capital payoff total. Gross capital payoff, but we're going to be conditioning it, and this only for the firms that goes bankrupt. So when we calculate this, we're going to use this truncated part of the PDF, right? We're only going to do the same. So this is just the expected total gross capital payoff of firms that go bankrupt. The cost of the firm doesn't go bankrupt. This is zero. We don't have to pay any monitoring costs if the firm does not go bankrupt. We just get this payout here. If the firm does go bankrupt, we then have to pay this share mu times the total gross capital payoff. The probability that that's going to happen, mu times here Right, so we see like there's a couple, from the bank's perspective, right? If omega goes up or down, this doesn't affect the payout if the firm doesn't go bankrupt, but it does affect this expected payout. We're going to have a larger mass of firms that don't go bankrupt. They're able to pay this back. So that's right as let's take a think now about how do these different pieces change. So for example, think about how the parts here change in omega. So I think now we have if this omega threshold goes down, right, then one goes up, not because the payout is larger, but simply because we now have a larger mass of firms. There are going to be more omegas that are above omega bar because it's fallen. So our expected return from firms not going bankrupt as a bank is larger, simply because there are going to be fewer firms who go bankrupt. So omega going down is going to increase 1. All right, now what happens here? The returns, right, if this omega threshold goes down, well, there are going to be fewer firms. Fewer firms that go bankrupt. Right, so that would reduce the size of this. And those firms that do go bankrupt are on average going to have a lower total gross capital payoff. So average so we see there's a little bit of already which effect is going to be larger, which effect is going to be smaller. That doesn't change. And it's the same as 2. Both a minus. So you can think now about maybe some special cases. All right, how would this problem change if maybe it's like during the financial crisis when we did bailouts of as we're doing bailouts of our entrepreneurs. If you would otherwise go bankrupt, the government will come in and will pay your debt. No? Then we would have this payout would still be the same for the firms that would have otherwise not gone bankrupt. But now, and so imagine firms can't go bankrupt. Think of bailouts. All this means is the government will bail you out, you would otherwise go bankrupt, so you can put it together, and the bank gets that from everybody. The agreed upon amount here. And now, in this case, if you change this threshold omega, it doesn't matter to the bank. It doesn't care. But the bank just wants to get paid. Right? It doesn't care if it comes directly from the firm or if the government steps in to help out the firm, it gets paid either way. So it doesn't care what happens here. Right, so there's, you can think of rewriting this in different ways to capture different ideas, right? Or to interpret this a little bit different. Right? And then one way that I interpret it is combining these two. So we have the net returns, which is why we have this 1 minus omega here. It's the net returns, but you could split up the returns and the costs differently. Interpret the equation for the external finance premium S and provide an intuition for how the fact that S varies a firm's net worth affects the supply of external finance for entrepreneurs' production throughout the business cycle. Alright, so we start with the optimal finance contract, then we go through the maximization problem of entrepreneurs. Right, and we get then the optimal financial contract. And our optimality condition gets us our relation here that the premium, the expected premium, so the excess that we have to pay for purchasing capital over the risk-free rate is related negatively to the share of capital that's financed in our own net worth. I think, right, another way that would be useful to think about this, also imagine writing this as ST equals S tilde So we're just going to work with the inverse here, and then it's increasing. And this is a leverage ratio. Our total amount of capital relative to how much we financed ourselves. And what we're saying here then is the higher our leverage ratio, the higher the premium is that we're going to have to pay to finance this external capital. Right, so essentially, right, our leverage ratio just means we're riskier as a firm, or we're engaging in more risky investment, and the external finance premium is going to be higher and higher. Right, so this external finance premium then varies with our firm's own net worth. Oh, it's also part of this. So we want to explain then, write an intuition for how ST varies with firm's net worth. Right, think of now a sudden shock. happens if NT drops suddenly? Right? What might be a reason? Maybe there's a stock market crash. So I'm a firm, I'm an investor, I'm an entrepreneur, I have some funds that I'm using to partially finance my business. Right? And when I go to the bank, right, I suddenly see stock market's crashed. Right? Or right, I go there with my Bitcoin, and maybe the Bitcoin market has collapsed. Or you can think of exchange rate risk. Maybe I have collateral in one currency, and I'm trying to borrow in another currency. And if there's a large change in the exchange rate, then in the currency I'm trying to borrow, perhaps the value of my assets has dropped immensely. But you can think if the exchange rate of the dong to the euro went from 30,000 to 60,000, then the euro value of your Vietnamese assets falls in half. The value of the assets themselves might not have changed in dong, it might be just as productive as before, but if you're trying to borrow in euro, the value of your collateral has dropped in half. The reason why this this is a lot of problems that you had in 1996 in many countries in the neighborhood in Eastern Asia. Right, so what happened? So, well, I mean, we still want to build our factory. If our net worth has gone down, this actually means that we need to borrow more, right? I can't finance as much of my investment with my own money as before because the value of my money, my assets, has gone down. All right, so I have this double whammy. On the one hand, this is now precisely when I would need to borrow more, and this is then exactly the time when lenders are less willing to supply this external finance, right? Because we have to take on a higher leverage ratio. Right? It's more expensive. So exactly when we want to or would need to invest more is exactly when we are forced to pay a higher premium on this external finance, and this is then going to reduce the amount that we're able to invest, and then we have this feedback loop through output, and then back to net worth again. All right, so just, you can think of simply anything that reduces net worth is going to increase the external finance premium, which is going to reduce the amount that we can invest, reduce output, and then reduce net worth even further. Right, so this exacerbate the effective initial shock. That is our financial accelerator. Okay, so let's explain the link verbally between our entrepreneur's net worth and aggregate demand. That's what shows up in our IS curve. What's the channel that this net worth is going through? Well, it's going through investment, right, through the capital market equilibrium. As we just discussed formally, so variations in net worth is going to affect the supply of external finance available for capital accumulation. Right, and now you can think about why this is going to affect investment so much. If net worth goes down, if we were to keep investment constant, we'd have to have external finance go up. But when net worth goes down, it becomes more expensive to finance external capital. And so the amount of external capital that we get actually goes down. So the decrease in investment, right, is then doubly effective. One, the net worth, and then by moving the external finance in the same direction through this premium. provide intuition on how an exogenous reduction in the return to capital affects our entrepreneur's capital accumulation, and how does the financial accelerator mechanism work to exacerbate the shock to this return. All right, so what's going to be changing our net worth? Well, we're going to have labor income as an entrepreneur, and we're going to pay ourselves a wage out of our investments, or out of our projects, and then we're going to have an equity. And so how does this equity evolve? Well, our equity is equal to our returns from our capital investments minus the costs of borrowing. All right, and how much does our borrowing cost? All right, well, we have on the aggregate here, we have borrowing that gets paid back at the agreed upon risk-free rate. And then we have the borrowing that isn't paid back, but is only partially partially recovered through this monitoring. So we have we're just going to keep that part and this part. So this is the whole return here is our the return on capital, right? Yeah, this is what the bank gets. So we'll look at what the firm gets. We get the return on our capital, and then we have to pay back on our borrowings, and the rate that we have to pay back is the risk-free rate plus this premium that covers the monitoring costs, that covers the default costs the bank incurs from those firms who go bankrupt. So in essence, we are paying an individual firm, even if we don't go bankrupt, we are paying for other firms' bankruptcy. If these costs are put on the bank, then the bank ends up charging us by demanding a higher rate. Let me give you an example. It'd be interesting to know, when you start to look at the financial sector here, exactly how the rules of financial markets in Vietnam work compared to other countries. So I'll give you the example of the United States versus Germany with on the mortgage market. So buying a house, yeah. Mortgage market. There are also variable interest rate setups. Let's think of just fixed rate mortgages. In the U.S., any time during mortgage is possible without fee. So in America, if I win the lottery and I have a mortgage, I can just go to the bank and say, here's the outstanding amount of my mortgage. And that's gone. That's not allowed in Germany. In Germany, early repayment requires paying or reimbursing the bank for the future interest payments we won't make. Right? So if I win the lottery and I have a mortgage in Germany, I go to the bank, I have to pay them the outstanding amount of the mortgage, plus all of the interest payments that I otherwise would have made until the mortgage matures. Right, so mortgages in the US are cheaper, right? Are they? What do banks in the United States do? Who's paying for the people who pay back their mortgages earlier? The banks, they're giving a present to people? No. Everybody pays in America. The average mortgage rate is higher than in Germany because everybody is paying for those people who do pay back early. In Germany, the only people who cover the costs to the bank of paying back the mortgage early are those people that actually do that. So on face value, it looks like you have more options. So why is this useful? Like in a mortgage, so in the United States, imagine the interest rate goes down. I'll go to another bank, open up a new mortgage at the lower interest rate, pay back my old bank, and now I just have a lower interest rate. So every time interest rates change, I can refinance my mortgage. In Germany, that doesn't make sense. If the interest rate goes down, I take out a new mortgage at the lower interest rate. The difference, the savings that I'd make, I have to give to the bank out of my old mortgage. So it would seem like it's more attractive to engage in a mortgage in the United States than in Germany, but it's not. So we can think of the average income loss to banks raises all mortgage rates. That's exactly what we have here. Everybody, all the entrepreneurs are paying a higher interest rate. Even those really successful entrepreneurs, in the end, are having to pay back the banks, right, for the bank's losses for lending to entrepreneurs who go bankrupt. So, and this is a key thing also I think to keep in mind, and this comes from our arbitraging solvents from if you look at any sort of financial problem, particularly if you're later on working at a regulator, always imagine that, or keep in mind that if you change the rules, try to set up the optimization problem for the bank is going to find a way, right, to recover this lost profit. It's going to come out in some other way. And it's important to understand that because you might have good intention. We want to make things more flexible for the consumer. Okay, super. Oh, but now everybody has to pay more. So what happens is the people who didn't want the flexibility are having to pay for this flexibility that they don't want. Oh, here, only those people who want the flexibility, who use the flexibility, have to pay for it. Okay, yeah. So now I want to think about what happens if this returns to capital goes up. This increases the return on capital, hence increasing the firm's equity and its net worth. Right, well, if the return on capital is higher, we're going to want more of this. More of this capital. All right, now, our time-bearing finance premium, then, the effect on this return, of this return on a net worth will also increase capital accumulation. Right? So return goes up. This makes buying capital more attractive, but it also increases the value of the capital that we have, the capital of these projects, increasing our balance sheet. So then the external finance premium goes down, right? Increasing capital even further. So this financial accelerator, right, the feedback from changing, lowering here the external finance premium magnifies the initial direct effect. Explain how asset price flexibility in QT works to reinforce the financial accelerator effect. So with our capital adjustment costs, the price of capital is going to vary with our investment. So changes in investment are going to then change, or change in the cost of capital is going to change and it's going to change our effect on net worth. Leads to an increase in our capital accumulation. That's if the price of capital goes down. Now, if the price of capital goes up, so the value of capital goes up, it's going to increase our net worth. Right. It's going to lead us to invest more. Right. And this increase in investment is going to increase the price, the value of capital even further, reinforcing that whole process. Okay, so let's look at this impulse response function expands monetary policy again, and now I want to interpret the response to a, right, yes, so it expands the monetary policy shock. differences, also that a good example of something that might come up in the exam is doing all the math to calculate, right, even this method on term of coefficients. There's maybe some on some of these smaller problems you can do. That's what we see in the practice exam, but maybe otherwise, you can interpret or think about, an interpretation of an impulse response. Okay, so we have the standard effect. Monetary policy is expansive, interest rate drops. This is going to boost output. Right, we're going to have output goes up. This means the natural rate hasn't changed. This increases the output gap. Marginal costs are going up. This is going to increase inflation. Demand goes up. Also, demand for consumption goods and for investment goods. Right, and think of here the drop in the normal interest rate is going to make investment, right, think of this yardstick and measuring stick goes down, so more projects are now worthwhile. Again, here you can see what I mean, hopefully, by this measuring stick, this yardstick. That's the arbitrage argument. Right? We're comparing our risky investment in the bank versus a safe investment. If the safe investment's return falls, right, this is going to change our incentives. It's going to make projects that before would have been too risky, perhaps their expected return wasn't high enough, now are going to be worth our while. Okay, we have the sticky prices, so inflation goes down because it goes up. The output gap goes up, but it does not go up by as much as it otherwise would. We have the real rate also going down. Right? Inflation doesn't go up by as much to fully eliminate this effect, so we have then a positive effect on we have a negative effect on the real rate from this drop in the nominal interest rate. So we have a higher return, higher return on capital. This increases our net worth, as we've seen above with the financial accelerator. The increase in net worth is going to further increase our capital accumulation, investment, because we're reducing the cost of borrowing. Right? We're reducing this external finance premium. Which key variable drives the different effects of the monetary policy shock within financial accelerator? And why does the monetary policy shock have more persistent effects if a financial accelerator mechanism is in the model? Right, so it's this movement in the external finance premium. So when firms, the value of firms' net worth, if the value of firms' net worth feeds back into the costs that they face, they feed back in negatively, so an increase in the net worth decreases the cost of borrowing. That's going to lead to more borrowing, more investment, more output, and hence then even a better, improved financial position, and hence lower premium. If the external finance premium stays constant, right, then we have this drop in the real interest rate. We're going to invest more, invest a little bit more, and that's it. We don't have a feedback loop. We also have endogenous persistence, right, and that's comes from this accumulation of net worth. Right? When we have net worth, it's only slowly going to revert back to the steady state. So if we have a persistent shock, so next period, the nominal interest rate is still somewhat lower, but we have alongside this somewhat lower nominal interest rate, also an increased net worth. So next period comes along, and it would go, the effects of monetary policy would diminish more quickly without the financial accelerator, because in every single period we have this nominal interest rate as well, but also the net worth. Also, do this. Let's make monetary policy shocks non-persistent. So turning off the autocorrelation in our monetary policy rule. And so first that's the case here, I want to plot here and plot. On H. Net worth. Output. I don't know what the external minus. Determinacy, so monetary policy has to be a little bit persistent. Right, so these we had in the lecture, but now we can see the addition of net worth. Right? And what this gives us, we have a very persistent increase in net worth in both cases. So it's larger with the financial accelerator, but in both cases, even back 3 years out, we still have higher net worth and steady state equilibrium. That's irrelevant if we don't have the multiplier, the accelerator effect. If this elevated net worth doesn't translate into a decrease in the premium, right? It's just measuring, right? Our firms are doing great, fantastic, but they still charge the same amount. In the solid line, right, we see that there's an exact this inverse relationship. The higher the net worth, the lower the premium. Right? And in contrast, right, to without the financial accelerator, 3 years out, we still have accelerated net worth. It's about 1% higher than before, which is giving us then this discount, this decrease in our external finance premium, which is what's for instance, less expensive, making it less expensive to borrow. So firms are borrowing, investing, and producing more. Let's look at a much let's go out. How about 10 years? So the initial period plus then 40 quarters afterwards. Go out further now, what we see very quickly, monetary policy shock without the financial multiplier. This is the wrong plot. see that the net worth is a little bit less persistent with the financial accelerator. Right? Why? We have this endogenous response to inflationary impact, when output is higher for longer. This is also going to mean the output gap is higher than longer, causing more inflation, causing the central bank to respond with the nominal interest rate. Right? And so we're going to have some interest rate adjustment effects. But if you look at the case without the financial accelerator, very quickly, so a couple years later, there's no effect directly from the nominal interest rate. It's just converged back to what it was before. Output is also very quickly falls back down. So we have this smaller magnitude, but then also, right, it's very quickly dissipates. The fact that net worth stays higher for longer doesn't play, is irrelevant because it doesn't generate a larger premium. With, however, the financial accelerator, even 10 years out, we still have an effect of the shock. By itself, it would have long been gone, right? But we have an elevated net worth, which means still to a lower financial premium, which is giving us a boost in output, and this is then giving us that feedback in the nominal interest rate as well, which is why we see that. So we have these real effects of the monetary policy shock even after the shock itself has died out. And then finally here, interpret the difference between the impulse response of real output to positive shocks and level of technology aggregate with or without a financial accelerator. All right, so we saw this one in the lecture. We have the financial accelerator. It's just going to magnify the response and output to all three shocks. Positive shock increases investment, increases output asset prices. This raises net worth, reducing the external finance premium, right, meaning that firms, entrepreneurs can and will borrow and invest more, increasing output, increasing investment in asset prices further. That's the cycle of the accelerator. And because we have accumulation of net worth, then we have an increase in the persistence. So you would just think through, try to understand, walk yourself through a couple of times on how this financial accelerator mechanism works, right? Intuitively, right? And you now have a tool in your box. Right? So think about it, some a modeling piece and understanding why. One explanation for why financial markets can interact here with our real economy and monetary economics in a way to magnify these effects. Without a financial accelerator, we have virtually no effects of this net worth on capital accumulation. Right, and so having, I guess, so this is the end of our content. We'll take a break and then we'll look at the exam together. But we've looked at a bunch of different models here. You know? We looked at goods market, ISLM. We looked at ISLM. We then extended the open economy. We looked at a consumption savings model. We looked at asset pricing through no arbitrage conditions. We've seen that these no arbitrage conditions showed back up and pricing assets that a bank can buy. Should we loan to risky investors or should we loan to the bond market? We've seen this consumption savings model comes back up in our optimizing all the models outputs behavior of households. That same Euler equation, the same Euler equation intuition we had in a two-period model, right, is exactly what's behind here the dynamic IS equation, which itself was just a dynamic extension of the IS equation that we reviewed that you've done in previous courses. Yeah? All right, so we have a number of different models. There's overlap connection, and some are extensions of the other one. Right, these DSGE models are very useful for precisely this. Right? They're telling us the magnitude of the impact and persistence. Right? So, again, so imagine you're working for the Central Bank of Vietnam, and they're considering considering doing different policy measures. Well, for the decision makers to be able to make their decision, they have to have some idea what's going to happen. What can you do? Well, to give them an intuition to explain qualitatively. Right? So if you raise the nominal interest rate, this is going to reduce investment. Investment is a component of demand. Right? You can see this in ISLM. You can communicate that intuition straightforwardly with those ISLM models that you've seen before and that we've reviewed again. It's very important to have them because that's a level that you can communicate with policymakers and people who are non-economists. Right? So give them the ISLM. You can give them the curves and shift the curves around and explain this to them. Right? And, okay, I'm the kind of kid. Okay. But now when they need the numbers, okay, so what happens if we lower the nominal interest rate by 25 basis points versus 50 basis points? What's the total decrease in output? Well, let's say let's lower the nominal interest rate by 25 basis points. What's the total cumulative output increase over the next year? Right? All right, well, we have 1%, 1.4% on impact, we can sum this up and say, so we expect total annualized output income increases of here maybe 4% or 4.32% over the next year. We can give them a precise quantitative forecast. So, okay, interest rate goes down and output goes up, but it might be important to know by how much. If the output effect is large or small, might be important for making this policy decision. Right? And that's what these DSGE models are very good for, is they're going to give us quantitative answers, right? And they're going to give us dynamic answers. But the intuition, right, to understand the consumption Euler equation, right, the first order condition of optimal savings, the infinite horizon of consumption, all we needed was 2 periods. The consumption savings equation, a model. 2 periods was enough to understand the intuition. ISLM, static, no adjustment of prices. We understood the intuition, and we could think through what's going to be the long-run effect of prices adjust. Intuitively, qualitatively, we can do it with that. Right? And our DSGE models help us spell out explicitly how these things are going to react, and also give us a laboratory, because we have these optimization, these first principles of all of our agents. If we change completely the way policy is designed, right, we're going to have agents responding internally by adjusting their behavioral patterns. So we'll get, right, our agents will learn and understand the effect of policy changes and will respond accordingly. So we're not going to be making the dubious assumption that nobody's going to understand what we're doing, and they'll keep doing what they did before. All right, let's take a 10-minute break. We'll come back and look at the exam, and then we have to say goodbye. Well, then we're going to have lunch. Then I'll say goodbye.